We're going to talk today about mills entertainments, a little bit from the IRS perspective and also from the government contracting perspective, which unfortunately do not quite match up. The agenda is going to be, we're going to deal with the issue, deal with the IRS, government contracting, and then just a few seconds on accounting issues, because both the IRS and the government contracting agency, DCAA, normally both require accounting issues to be addressed to make it compliant. So let's go ahead and start. All right. Rules of mills entertainment expenses while on travel are pretty well documented and within the regulations both for the IRS and the DCAA. And I'll just refer to the government contracting from now on as DCAA. Unfortunately, the regulations for mills and entertainment when not on travel are not clear and are often applied inconsistently by government auditors. I had the most common example of that, one of the worst ones I had a couple of years ago, with the supervisor who declared that only mills that were on travel were allowable and all other mills were unallowable. So you can and he went through some twists to make that in the regulation. So, okay. So often you have to go ahead and make decisions on a case-by-case basis. And this is why training and knowledge of the regulations and the statutes is sort of critical. And there's two audiences involved, DCAA and the IRS, and they both look at this differently. Surprisingly enough, the IRS is usually more lenient than DCAA is on this issue. And we'll get into that a little bit too. But on the other hand, the courts have not interpreted the thing strictly. And we're going to talk about a famous case that is still being quoted in more recent cases that sort of really define the standard, but which 99% of the DCAA auditors have no knowledge on and they're not trained on. Okay. So we'll basically look at the requirements for the IRS and focus on the government contracting, like I said. Okay. In the majority of cases, it's impossible to separate social aspect from the business aspect. So that led to the 50% rule, where only 50% of a business mill is assumed to be deductible. There was a period that just recently expired where we had a higher percentage of 100%, but that has expired and we're back to the 50% law now. There is also an 80% deductibility under Department of Transportation rules for like truck drivers and other ones whose hours of services don't fit into the normal 8-hour framework. So I'm not going to discuss that really. I'm going to still with the 50% and the rules for that. Okay. They're generally related to, you have to be business related. You can't take your kids to Disney and deduct. Okay. There was a change in 2024 where the IRS sort of adopted the standard that all entertainment expenses are unallowable on the face of it. Where beforehand it was, well, you have to determine on a case-by-case basis. Now the assumption is that they're unallowable until you deal with the exceptions or otherwise. And these exceptions for the full deduction include not the 50%. Let me talk about that. There are cases where you can take the 100% deduction, and I'll talk about that. And that gets sort of complicated on the government contracting side with subcontractors. So where you can take the full deduction is obviously you put it on somebody's W-2. If they're having to pay taxes on the entire amount, then you can deduct the entire amount. If it's a pass-through, if you are billing it to your client, and that includes, that's the subcontractors we'll talk about later or to your customer, that then you can take the 100% benefit. That's for the benefits of the party. If you're doing a Christmas party, you can take 100% the full deduction. And that's good to go. Giveaways. If you're giving away, a coupon to a restaurant or something like that, that's 100%. And if it's in the course of business, if you're a restaurant and you're giving away food, then that's 100% deductible, as opposed to going to a restaurant and ordering. Okay. Let's see. Other exceptions for let's see, brought about those, Other exceptions are where there's no deduction if it's personal or excessive. Again, this is the IRS rules. The excessive is not as well defined as the other as it is in the government contracting one. And the IRS republished publication 463, which addresses this stuff. And they used to have this wonderful table in the old one, but they've replaced, but since they changed some of the rules, they didn't replace the table. And now here are the rules. Okay. I'll just give you a moment to sort of look at those. It's got a definition of entertainment and the de facto thing where it's assumed that you no longer can deduct. Here's the other one to look at. Exceptions to the rules, entertainment treated as compensation. We talked about recreational expenses, holiday party. We talked about that. This is lifted just off the publication. Expenses related to business meetings or conventions. There you go. Entertainment sold to customers. There you go. All right. So that's the actual IRS guidance. Now here's exceptions for the 50% again. I know I'm repeating myself, but that's the way IRS does that. Let's talk about treated as compensation. If it's reimbursed under an accountable plan, and that's also where per diem can fall in. So if you have an accountable plan where they have to turn in receipts or count for their time or use the per diem thing, then that can be an exception and you get 100% deduct. Recreational expenses for employees, like we said, advertising expenses, if you're giving away free food or entertainment, then that's deductible. And the sale of meals, like in a restaurant. Okay, let's talk about this is where it gets a little tricky for contractors, government contractors. A 1099 subcontractor is not limited to the 50% deduction. However, the customer that they're sending the bill to is. So I have a lot of clients where when they reimburse meals for subcontractors, if they're not using a per diem structure, but then they go ahead and have a separate subcontractor's meal expense account. So they know that they can only do the 50%. And that's, and over the years, that's almost everybody has an account called Meals and Entertainment in their chart of accounts. On several occasions over the years, in fact, I had one DCAA auditor who strongly objected to having the account because he thought it was completely unnecessary. Despite the fact that I told him that the contractor needed to segregate it for IRS tax purposes, but he just didn't think, he didn't do anything about it, but do his protest. Okay. All right. Okay. Now we talked about that. Give me some additional challenges, which we discussed later. I guess I just did discuss them. Okay, let me point this again. None of this is offered as tax advice. You need to consult with your tax account thing. There are state laws, like in West Virginia and some other states, that actually can impact this too. So you need to talk to your local tax advisor and confirm everything I'm saying in here or argue about it. Okay, now let's move on to government contracting. Okay, they're more, like I said earlier, the thing, it gets a little more complicated with DCAA. First thing, because their guidance is written a little bit weird. The regulations are written a little bit weird. Also, they get paid less than IRS auditors do. And so their training may not be as good on some of these subjects. And it's also an easy thing for them to pick on. I probably had more fights about travel and meals and entertainment than anything else. Also because it's something that contractors usually don't do the best job in the world for. Like a common, to get a little bit into the weeds of the government contracting, a common thing for a contract. I had a contractor that got in trouble. One of the things most young DCA auditors will say is that you can only rent economy cars. And then when you ask them to point to a regulation of guidance that said that, they can't do. In fact, in my second book, I have a screenshot, and I updated it a couple of years ago. I have a screenshot from Expedia where renting an SUV is actually cheaper than renting the economy car. Plus, what if you got 6 people? Do you rent 6 economy cars or one Tahoe? So it's one of those things that it's what I call water cooler auditing, where they go around the water cooler and they discuss these things and they decide it's a good rule for everybody else. But so I had one auditor decided that the direct rental cars on this contract were unallowable. So what the contractor did from then on was made all of the rental cars unallowable, which of course got him in trouble because if it's direct, it's not only the direct cost of the rental that's unallowable, it's also the associated G&A and indirect costs and profit. And so that was so you got to be careful of this stuff. You got to follow the rules and talk to somebody if you're not sure about it. Okay. All right. The FAR pretty much leaves the government contracting stand with the government accounting. So that's another important case. If you're, this is something that since 2008 has gotten a lot more confusing. In 2008, GSA and the IG, the Department of War's Inspector General's office, published two audits that were extremely critical of the government audit agency, DCAA. FAR 42.1 names DCAA as the de facto auditor for U.S. government contracting. That means that if the other agencies like Department of Agriculture, Department of Commerce, or Department of Energy, if they're not using DCAA, they're still looking for DCAA to provide them guidance on how things are supposed to be done. 2008, these two audits came out. GSA looked at 55 audits that DCAA had done and concluded that 53 of them were worthless. The director of DCAA retired. A new person was appointed, and his solution was basically not to do any more audits. Before 2008, the number of audits done by an auditor a year was averaging about 9. And the way I get that statistic is I take their report to Congress, look at the number of audit reports they issued, and divide it by the number of auditors. It's a simple simple matrix to do that. That has not now gone down to 0.4 last year. Audits per auditor. And when you consider that most of the audits I deal with now have at least 2 auditors involved, then we're talking, one audit or 2 audits every couple of years now is what they're doing. So that has complicated these issues too. They are awarded, and there's a lot of great DCA auditors right now. I'm dealing with the team in Silicon Valley at the moment, and they're just superb. And then I've got auditors I deal with that are not so great and not supported adequately. And so it becomes a lot of personality, which means the more you know the regulation, the more you know the guidance, the more empowered you are to figure out and make an assessment about whether you have to rent economy cars is actually real or not. Okay. All right. So and that's what I just said. All right. You have to look at the actual regulations and how DCA interprets them and make an educated decision on your own. Okay. So the issue divides into 2 areas pretty simply in the regulation and the guidance. Let's talk about regulation and guidance involved. There's statutes, with the law that Congress passed, like the most famous government contracting one, that you can't charge interest to on a government contract, and executive compensation. They set limits on executive compensation. And then there's regulations, which is where the agencies go ahead and publish regulations to enforce the statutes. And then there's guidance. So, for example, on executive compensation clipped up over the years to about 7 digits, and that's how much you can claim if you own your payment to your CEO or your top employees. And then Congress went back and reset it during the 2017 tax bill back to about $400,000. It's creeped up again to about $650,000. But DCAA does not accept that limit. They take the position, which we'll get into in a few minutes, that they will decide whether it's reasonable and prudent. So often they will come back and argue that a compensation is not reasonable and prudent. And they have guidance on that. I had an audit once where the auditor had done a lot of research on me. This is in Hawaii. Had done a lot of research on me, and she thought she had me nailed. She said during the entrance conference, "Well, we know that guidance is not statutory or regulation. It's just guidance." And I said, "For the contractors, it's guidance. For you, it's your standing orders, and you have to follow them." And so I'll leave that there. Okay. So I'm not going to spend a lot of time on travel M&E because they're pretty well covered by the joint travel regulations or the federal travel regulations. FAR 31. Now, my favorite part of this here is to point out that these actual regulations are contradictory. The joint travel regulations in the preface and the first part of the regulation specifically says the joint travel regulations cannot be applied to contractors. Okay. However, FAR 31 says that it is specifically applied to contractors. So pretty much, we all follow the JTR or the FTR. The JTR being the Department of War's one, the FTR being the regulation for the rest of the government. Okay, so you got to follow the per diem outlines published by GSA or by the Department of State. For example, when I travel to Saudi Arabia, I follow the Department of State per diem, and because the joint travel and the FAR FTR only apply to domestic and even sometimes only continental U.S. Okay, and then you can have special and unusual circumstances. I don't remember I talked about this later, but there, I had a Lockheed Martin thing where we would, where we were dismantling nuclear missiles and submarines that Russia had left, the Soviet Union had left in Ukraine. Does Ukraine sound anything familiar? This was back in the 90s. And so we had made a commitment to Ukraine that we would protect them if they turned over these nuclear submarines and short-range nuclear missiles, SRMs, to us. And so nobody had ever dismantled and taken apart a Russian submarine before. So it was a very expensive project to do. And we were always, at that time, relationships with Russia and Ukraine were a lot simpler, a lot easier. We actually ran the contract Lockheed Martin did out of Moscow. So we were always flying people at the last moment to Moscow to deal with some flare up between the Ukrainians or the Russians, or between the Russians and the US or whoever. And a lot of times we could not get the economy class, which back then was the standard. So we would fly business class. So that would be an example of an unusual circumstance. Non-travel now, but back to meals and entertainment. We'll stick back to this. The regulations, there's three main sections on it, and you have to look at all three together. And then there's a court case, like I said, a famous court case that interprets these, or appeals board case. Okay, so there's 31-205-14, which is entertainment costs, and which seems to be the only one DCAA reads half the time. Then there's 13, which is employee morale, welfare, food service, and dormitory credits. And then 43, which is trade, business, technical, and activity costs, which is the one they always forget that actually mentions entertainment and M&E in it too, that these things are allowable. So those three together form the basis for determining government contractor allowability. And they are fairly narrow in construction. A simple reading of them would basically say, when the auditor says all meals in town are unallowable, that was not too far whacked until we did it. But the establishing section of 31, the preface to the entire 31, and 31 is, I have in one of my books, I have a quick reference sheet for 31. 31 is the section of the FAR that tells you everything that is expressly unallowable. I had an auditor a couple of weeks ago who I can't remember where it was, but I had an auditor a couple of weeks ago who interpreted that if it was listed in 31, it was unallowable, which is not true. 31 just tells you how to deal with these costs. So the very fact that travel and meals and entertainment or entertainment costs were listed in 31, he said automatically made them unallowable. And I said, you need to go back and read the regulation. Okay, so here's where we talk about reasonable and prudent. When a DCAA will often tell contractors that the responsibility for proving allowability rests with the contractor. And that is not completely true. The job of an auditor is to form an opinion, either an initial opinion or a final opinion. So they first have to form an initial opinion on it, say this is unallowable. Once they have to support that opinion either by statute or regulation or by reasonable and prudent standard that we're going to talk about. So they have to come up with a statute that says, like even the interest one. If you read the regulation in FAR 31 about interest expense, it says financial interest. I don't know whether people are familiar with some of these complicated accounting rules that come out for right of use. That's not financial interest, so that's allowable as a simple reason. But then they have to follow these reasonable and prudent standards. And so we'll talk a little bit about what the reasonable and prudent standards are. It has to be reasonable. You have to be allocating it correctly, either direct or indirect. It has to follow standards from GAAP or by the CAF board if you do that. There can also be restrictions placed on the contract that says we're not paying for any travel above X amount. That's a pretty common one. All travel has to be prior approved by the contractor officer. That's another example of where it becomes unallowable if they say so. Okay, now here's the standard for determining reasonableness. That's where my term prudent comes in, is in the first sentence. Reasonable in nature and amount, it does not exceed which would be incurred by a prudent business in the conduct of competitive business. I don't know what prudent means the same thing now that it was when this regulation written, but that's what it is. Okay. No presumption of reasonableness should be attached to incurrence of cost by a contractor. That means you have to review it and check. All right. And they notice the last sentence is where the burden of proof switches to the contractor. If the initial review of the facts results in a challenge of a specific cost, then the burden of proof goes to the contractor. But initially, they have to assert that they don't agree with this and why. I had a case once where we were renting apartments because the DOE was complaining about the cost of all the hotel rooms because they were moving people and specialists. And the auditor said, well, when she questioned the apartment rentals, she said, well, it just doesn't feel right. I said, how do you make it? If that's what's making based on feelings, give me a regulation or a reasonable and prudent argument. And she couldn't be bothered with that. Okay. All right. So let's look at the specific subparts. All right. Entertainment costs. And these slides are going to be available to you all also, right? So if not, you can get a hold of me and I'll send them to you. But I think they're going to. So, okay, if you look at this, it looks like almost everything is unallowable as an entertainment cost. And it's true. Part of it is the term that hinges on this is social activities. Because it's social activities and not activities. If the only purpose of the entertainment is social and not employee welfare or anything like that, then it's unallowable. If you take, again, it's not as black and white as many auditors would like to think it about. Okay, so here's what you go. You have amusements, diversions, social activities, and either direct are the tickets to the sport, and then the associated meals, lodging, transportation are also allowable. There was a case Raytheon had on a similar matter a couple of years ago where the government successfully argued that the timesheets associated with this, if anybody was charging time on this for preparing for or doing this activity, those were also unallowable. Okay, so in this case, take a vendor to a football game, the cost of tickets, parking, hot dogs, and so on cannot be claimed despite the fact that you spent the entire game discussing business or even have to call from the rest. That wasn't good. But pick the same vendor to dinner and the roads get a little foggy because dinner is not necessarily entertainment or a social activity. So now we go to 43. Trade, business, or technical professional. Okay. Gets the impression that it's written to deal with professional activities such as meeting, conventions, seminars. But both DCAA and the various contract codes expanded this to include non-typical travel meals. Okay, so here's the critical part. When the principal purpose of the meeting, convention, and meeting can be local, all this, is improve productivity or stimulation of production or professional information, business, technical, costs are allowable. Okay. So there's 3 requirements for it to be allowable. business information, production similarity, or productivity improvement. There you go. And the productivity improvement has been the broad one that a lot of the cases have been working on pretty seriously. Okay. The last two seem similar, but they're a little different. All right, so here's finally the famous case, Cotton and Company. This case is really old. It takes place in I think before 1986. So when this case took place, alcohol was still an allowable cost of government contracts, which was outlawed in 1986, which sort of dates me how long I've been doing this. The Cotton case is still being quoted. I got it quoted in November. It's also been quoted in a couple since of that. The November one was just great. The Cotton case was where a CPA firm in Washington, D.C. had a contract with the government. And every Friday afternoon, they had a tradition of a happy hour that where they unwound, ended the week, had a couple of drinks. Like I said, back then the alcohol was allowable, now it wasn't. And DCAA ruled all of that unallowable. Okay. Now here's a quote from the Cotton Company thing. Before ruling the reasonable of these costs, we note that lunch and dinners to discuss business matters are not readily definable as performance-related or necessary business expenses, since the company can operate without these costs. Because we view them as purely discretionary nature and subject to contract abuse, we hold the contractor to a higher burden in justifying these expenses. Okay. So it looks like it's saying DCA reads the first part of that and say, okay, see, so you can run a business without. That's what I hear from DCA auditors a lot of time. But as this case specifically says, that's not the standard. The standard is that you have to justify the expense, not that the expense is unallowable. So the moderation and frequency, there's no hint of abuse, and abuse is the standard. Again, I'm not a lawyer. So here's the three things that Cotton specifically allowed. Lunch to discuss employee performance, lunch to discuss promotions, lunch to discuss company business, and Friday afternoon get-togethers. That was very specifically, all of those were deemed allowable in the Cotton case. Like I said, it's still being referenced. And as you could tell, that's fairly broad. Now you just need to document it. Okay. We find that taking an employee out to lunch, is a good idea. Responding by challenge the credibility of the offense, whether it argues the cost should be disallowed because there was no reason for doing it. You could have done it in the office. We do not find the DCA's arguments convincing, or the government's arguments, assuming it can take place at lunchtime in a restaurant. You can do it. They have business at work, lunch together. So, and let's go to 30 to 13. I know I did them out of order. Okay, here again, aggregate costs designed to improve working conditions are generally allowable. Okay, house publications, wellness centers, employee counseling service, food and dormitory service for contractors, employees, etc. Those are the ones specifically allowed. And then this is what the Cotton said about the Friday get-togethers. Okay, that was one way they put it. There was one comment by one of the off the record that was reported later, where one of the judges said, why in the world would getting together after a week of dealing DCAA, would you not spend Friday afternoon drinking? So that was my favorite comment that was put on part of that. If you go the other way, let's talk about this. All right, here's a recent one where they failed to meet the standard. Very simply, if you don't document what you're doing, don't charge it. You know, when the IRS used to be pretty strict about that too. And we used to write on the receipt what the business purpose was that we discussed at lunch, so they could put it on the voucher when we paid it, or give the credit card bill. And that's still probably a good idea. We'll talk about the dangers of thermal receipts in DCA auditing, because those things, by the time DCA gets around to auditing you, your thermal receipts can fade. So I actually had a disallowed cost once because nobody could read the receipt. And it was paid for in cash. And so it's always a good idea to scan them, even though that's a separate discussion. Okay, so again, documentation, cost, attendees, business purpose, frequency. You got to be careful, even though Cotton did that. If it's institutionalized, if it's part of the company culture to have these get together, have an annual Christmas party, annual summer picnic, Friday happy hours, that is the one extreme of the frequency that's allowable because they're part of the company culture and part of the employee health and welfare provided to the employees. The other extreme is where you rarely take somebody out. I had an auditor, the one who disallowed, supervisor who tried to disallow local meals. I always try and come up with a ridiculous argument. And if they agree with a ridiculous argument, then I know I'm in trouble. So the ridiculous argument I proposed to them was, okay, let's say you're recruiting somebody and they're coming into town. And it's normal, usually when you're recruiting somebody, to take them out to lunch, all right, while they're in town, visiting the office, anything. Are you telling me that's allowable? And the supervisor said, the only way that would be allowable is that, I think I actually got this on a slide later, I apologize. The only way that would be allowable is that if it was put on the effective employee's expense report. But if it was put on the CEO's expense report, that would be unallowable. That one we appealed to DCMA and won. Okay. All right, so let's talk about accounting issues. Let's address the 50%. We talked about that before. It applied to include subcontractors and consultants on 1099. I've talked about this a little too. You have to still do the basic criteria about direct, indirect, claimed, and unclaimed. So it's direct, unclaimed. It still has to be burdened with the associated indirect costs, and the entire amount becomes unallowable. Okay. So that's again, you can't just put all of your unallowable costs in an unallowable account. You have to determine whether they're direct or indirect also. Okay, ways to track it, chart of accounts, tracking IDs or classes. So like a lot of times, we'll have 5,000 account for direct travel, and then in QuickBooks, you'll have a class that says unallowable. Or you can set up a lot of clients set up a separate chart of accounts for unallowable. DCAA likes to see those, but they accept classes. Most accounting systems will allow you to set up an extra dimension. I know David and I have been talking blue in the face about that with a client that we both have in Saudi Arabia. But those are good ways to track these unallowable costs and methods there. Okay, so unclaimed known entities, 8 things that you got to do the direct costs. This I just talked about. All right. So you guys have a good notes for everything I've said. I've done this presentation a few times, and I'm trying to. I apologize. I looked at my notes and everything. I'm still trying to remember what I said and what I wrote down. Okay, tracking IDs or classes used to direct cost numbers. We talked about that, and that's it. That's basically all I've got. There's a copy of my 2 books that are available on Amazon. The accounting policies and procedures is a cure for insomnia. If you ever have problems sleeping, I take the regulations or the guidance and reprint it, which I had one criticism for doing. Then I discuss the regulation of the guidance and how it applies, and then I give you sample policies and procedures for implementing it. The second book is a short book that basically says how to handle DCAA when they show up at your door for an audit. Focusing on the accounting system, but it pretty much applies to audit procedures. And with that, I'll stand for questions. David, you got any? Or
we do have one question from Ruben. He asks, is a holiday party deductible if you only have 1 or 2 employees and the majority of the attendees are clients?
Okay, I'm sorry, I could not hear. What was the first part of it?
Says, is a holiday party deductible if you only have 1 or 2 employees and the majority of the attendees are your clients?
I think that would depend on whether all the employees were invited. If all the employees were invited, I think you can make an argument for reasonableness. Plus, you remember that in 13 or 12, I think it was 13, specifically advertising was an exception where meals could be allowable, and so that would cover the clients. and marketing also. So I think, yes, I think I wouldn't have a problem with that, having just reviewed the regulations, everything. And that would be incumbent on the fact that you were not discriminating on which employees you invited. You can make the argument the other way, but I think that's what nails it.